In this third video, we'll be discussing accounting for the retirement of bonds. Bonds can be retired at maturity. In this case, it means that the company waits until the maturity date and pays off the bond. So at that point, any discount or premium on bonds payable should have been fully amortized, so the balance in those accounts is zero and the carrying value is equal to the par value of the bond. So if we have on January 1, 2023, Rain Company issues 1,000 bonds with a par value of 100, they have a maturity date of January 1, 2028. If the bonds are issued at a premium or a discount, any premium or discount should have been fully amortized, the balance is zero, and the carrying value of the bonds equals par. So that all we have to do is debit the bonds payable account to take the liability off the books and pay out the cash. In other situations, bonds may be retired prior to maturity. Some bonds are what is known as callable bonds, which means that they are issued with a call option, which gives the issuer the right to buy back the bonds at some point prior to maturity at a specified price. In other situations, the company may just go out on the market and buy back its bonds. Why would it do this? Well, if it issued bonds that pay an 8% interest rate and the market rate is now around 3%, they can save a lot of cash flow by recalling or buying back those bonds and then reissuing the bonds at a lower interest rate. In these cases, a gain or loss on retirement is likely going to occur for the difference between the purchase price and the carrying value of the bond. So we have an example here. On January 1 of 2023, Misty Company issues 10,000 bonds with a par value of 100 at 103.6. The bonds have a 2-year term, an 8% contract rate, and pays interest semi-annually on July 1 and January 1. So this is a problem that we worked for a premium on bonds payable in the previous video. But we're going to add a factor here and say that Misty pays 102 to retire the bonds on January 1 of 2024. So they issued 2-year bonds, and after the first year, they pay to retire the bonds. And they sold the bonds at 103.6, and they are paying 102 to retire them. So we're going to go through a series of steps. We want to compute the carrying value of the bonds at the retirement date. Remember that carrying value is the face amount minus the discount or plus the premium. We're going to compare the purchase price to the carrying value in order to calculate the gain or loss on retirement, and then we're going to make a journal entry. We're paying out cash. We want to take the bonds payable account off the books, but we'll also need to take off any remaining balance in discount or premium. So what is the carrying value of these bonds on that date? We calculated earlier that the semi-annual amortization is $36,000 divided by 4 interest periods, or $9,000. 2 interest periods have passed, so at this point we have amortized $9,000 times 2, or $18,000. We started with a $36,000 credit balance in premium on bonds payable. After we've amortized the $18,000, we have $18,000 remaining. So the bonds payable account and the premium on bonds payable account both have credit balances, so we add those two together to get the carrying value of the bonds, or $1,018,000. So our purchase price was 1.02. So we take the million, we multiply it times 1.02, and we are paying $1,020,000 to pay off debt that's on our books for $1,018,000. And the loss on retirement here is going to be the difference, or $2,000. So in this journal entry, we want to take the remaining liability off the books. So we're debiting bonds payable for $1 million. We also want to take any unamortized premium on bonds payable off the books. We just looked at that T account and saw that there was $18,000 credit balance remaining, so we're going to debit that. Losses are like expenses in that they decrease income and they decrease retained earnings, so they get recorded the same way. So we're also debiting loss on retirement for the $2,000, and if you add those numbers up, they equal $1,020,000, which is our credit to cash.